All right, guys. So, hi, Doug. A couple of things I want to cover today. Um, Number one is just how much optimism is there? How much can we sustain? Is it starting to get kind of overpriced from the last week to 2 weeks? Pretty much what I thought could happen. I'll be honest. I thought we would get a deeper correction before, so like the week before. Um, the election. I thought we might get a deeper correction. We really only had that 1 week that powered below key levels and immediately was rejected. So I was a little off on how deep that correction got because I thought we'd get 2 or 3% more, frankly. But what I kept saying, and hopefully everyone took notes, was that come the 17th, 18th, 19th, just based on how incredibly bullish the response of the election was, that I could very much see a second wave of that based on the inauguration. Obviously, we had a massive election win, vote of confidence from the stock market, big rally, and then it kind of got sold back off over the course of the next 2 months. And so I was saying, I think there's a good chance now that, you kind of have part two, which is the actual inauguration coming in, all the policies that people were bullish on now theoretically being activated. And I think that's what we saw. I think most of the optimism in the market is directly Trump related. There are other factors, but I think if you're whittling it down, those other factors are minor additions to what I think is the overwhelming reason for optimism right now, which is around Trump. And it's a very interesting dynamic, which I've talked about recently, where you have a pretty interesting cohort of people who are very optimistic, and that's going to affect different sectors and do different things. So, all right. So, like I said, the first thing I want to talk about is kind of the overall optimism, if we can sustain it. I think there's a very interesting cohort of optimism around there because I think the general consensus, including my consensus, just a couple months ago, was that the biggest winners of the Trump election would be outside the Mag 7, outside of healthcare, certainly, that there would be, some big winners on the financial side. There'd be some big winners in utilities, nuclear, Bitcoin, obviously, some of those. And then we would see, just small caps in general have a big opportunity, and tech would be kind of fighting against the tailwind of all of the other sectors. Then, of course, over the last couple of months, you've had this complete reversal in tech. Obviously, Elon and some of the others have been part of the Trump bandwagon from the beginning, but he's really had a massive cohort of people on the tech side kind of come into the group, and I think that makes things very interesting from an overall stock market view because obviously tech is the most significant driver in recent history. And if they are also incredibly optimistic, and then you have these other sectors, then we're going to have a very different looking market, assuming that optimism can, survive because we've now grown used to a market where the trillion-dollar companies drag the entire market up when things are good, and they push the market down when things are not good. And that's pretty much been the case for most of the last 12 years. And now we're entering potentially, very important word, potentially, a phase where that shakes up a little bit, where you still do have tech optimism, but you have other optimism and small caps and things that are driving that actually give you a broader base in the market, something we really haven't seen much. Now, again, industrials, basic materials, financials, utilities, that's the second bullet there. Those are the sectors that I think are interesting. Those are the ones. There's several others too, by the way, but those are ones that I think have the opportunity to kind of catch up on the ground that they've lost in recent years. Where, like I said, it was really just the trillion cap companies pulling everything up. Energy and utilities and industrials really lagged behind. I mean, utilities had some big runs. Certainly, some of the consumers had some big runs, but in general, those kind of core companies really underperformed the mega cap tech companies. And so I think those are really interesting as far as playing to catch up in what could be a very, optimistic and healthy environment for some of those sectors. One of the big questions that I have is whether the big cryptos have another leg up in them in this month and I guess really all of Q1, or have we moved too quickly into the meme coin world where now all the capital is being diverted into people who want to make 1,000,000%, and they're actually pulling liquidity out of the major players. The ones that I have are Bitcoin, Ethereum, and Solana primarily. That makes up most of my crypto framework. And so I'm concerned about them. I think they still have lots of potential, but I'm concerned that so much of the liquidity is now diverted back into this meme coin environment where historically we saw, Bitcoin, Ethereum, and the other major players out achieve their previous highs by a really, really big margin before you got into the full meme coin mode and pulled some of that liquidity away. So that's something that could be different. And then, of course, how do other key sectors that are not just kind of foundational macro opportunities like utilities and industrials, but more that are policy related, like healthcare and defense, how are they going to perform immediately in the aftermath of the election that or the inauguration that we just witnessed yesterday? So, a lot of interesting things going on as far as I'm concerned. I think there's really unique opportunities, and I'm definitely hoping that this is a year where whether we outperform dramatically or not, that we do have a larger group of potential stocks that we can work with. Now, as far as sectors versus the indexes today, um, so far, I mean, we're one day in here, but so far, the sectors are doing quite well. If you guys are in automated options, we traded several of these sectors directly instead of trading the index because we thought they had a chance to continue to outperform in the short term. So far, again, we're only one day in, so can't pat yourself on the back too hard yet. But so far, really nicely overperforming. The SPY and the Q are 0.7, 0.8. But then we have utilities up 1.5, XI almost up 2%, XLB up 1.2, financials similar to SPY and the Qs. And then what might be even more interesting, by the way, great job if you guys did kind of follow my lead so far. I think this is a great sign for some short-term momentum here, but really interesting. We avoided XLE. Why did we avoid XLE? Because we believe that, even though energy had a huge week last week, a monster breakout week, and I think it has, potential to go higher, that the old school energy of which XLE is primarily made up is now going to have a difficult time competing against new energy. And for me, again, that's nuclear. So look at XLE down 0.3. Exxon is down 0.5%. U.S. oil, so oil is down 2.1%. And then compare that to nuclear stocks today or alternative energy stocks today. CCJ up 3.3%. UEC up 3.1%. It was actually up like 5% just a couple hours ago. GEV, which is maybe the best stock in the entire stock market right now, is up 2.63 again today. So you can see the breakout or the divergence on the energy side, excuse me, that I've been talking about, and quickly coming to fruition under a post inauguration Trump office. Now, of course, I think you do have a risk of these things getting too heavily priced in too early. I mean, energy is not exactly the fastest moving sector in terms of deregulation to where you actually get the impact because it takes, a long time to actually build things and set infrastructure up even after you deregulate. But some of these companies like CCJ and certainly GEV with a massive bankroll that they have are pretty well positioned to move quickly. That as soon as some red tape gets lifted, theoretically, they have opportunities kind of sitting right there on the table to take advantage of. So I think that's an interesting opportunity to keep an eye on because we could see, yeah, they look like they're overperforming now. There's some divergence now, but that might just be the tip of the iceberg if we get into full activation mode because the opportunity with nuclear that makes it so interesting is how much untapped potential there is. I mean, nuclear is just driving a small percentage of the country and the world's energy usage. And if you believe that it can not only grow, but that it could be the majority energy provider in the world, the upside is just hard to overprice there. So I think that's a very interesting balance. Are we getting too over our skis too quickly here with some of these moves in nuclear that are starting to kick off? Or are we actually underpricing the framework that's going to go into nuclear right now that could really dramatically change the landscape? So A lot of interesting things going on there. Okay. By the way, I still was trying to see if I could get this to share. I don't know if you can try under the stream there for me, but I was not able to actually get the streaming option when I attempted it. So you can give that a try if you can make it work. If not, no worries. We'll just keep powering ahead. No idea why it popped up on Friday with no issues for me, but doesn't pop up right now. Anywho, also, as far as just a look, a snapshot stocks today, obviously one very glaring surprise, or maybe not even surprise because it's been getting beat like crazy for 2 weeks now, but is Apple down 4.2% in pretty much a sea of green. Now, obviously, you do see some of the old school energy here, Exxon, Chevron, some of those, Oxy, some of these that are down. But Apple and Tesla are kind of the most interesting ones to be taking a hit right now, in spite of just an overarching sea of green here. The consumer that I really like Walmart and Costco, continue to be really good stocks. I've felt like for a while now that these have been arguably the strongest stocks in the market because they have the best balance of upside and optimism with defensive characteristics. So, still really like Walmart and Costco. But I think, there's just so many more opportunities at play right now in the current moment, compared to what we have seen over the last, I mean, really years. I'm not trying to overgeneralize it, but really years where the stocks driving the majority of the movement have been so narrow, and now I think we're really seeing that expand into a lot more. So let me move down here into the actual charts, and then I want to talk a little bit about buying time and what that looks like for us here. So this is just today as I was showing you. You can see XLI, XLU, XLV actually, which had a pretty nice pop. Basic materials, all kind of leading. Tech starting to bounce a little bit later in the day. Now, if you go back and you just look at the last month, you can see energy is really our big winner here, which is again interesting because if you just literally scroll back to any other previous time, you're going to see energy. This is the green line is energy. You're going to see it at the bottom here consistently. I mean, look at it at the bottom or in the middle, near the bottom, pretty much consistently over the past year, really since 2022, so past 2 years, energy has been at the bottom. And then all of a sudden, you look at the last month, and the biggest gap, our biggest winner is energy. Now, I'm hesitant because of, like I said, now that we're post inauguration, with how much opportunity I think there's in nuclear and some of those other companies, I'm not 100% confident in the old school energy, but I like the fact that there's some good plays in there, like OKE, some of the other ones that pay a good dividend. Devon Energy is a good one. As well, that's kind of old school that I like to pay a nice dividend. You can wait. And if this rotation is legitimate and we do catch up, because if you look at the 6 month, right, here's energy in 6 months up just 2%. Okay, so energy is up 2% in 6 months. If it blends out with the rest of the market to be up, 10, 12, 14%, obviously lots of upside in the individual energy stocks. And so for me, still worth holding on to those. I have, some of that old school energy, but I really like my GEV and my CCJ picks for more upside. For me, those are more interesting from an upside perspective. But like I said, I never mind holding some energy. It's normally pretty robust when the market weakens. Pays me to keep holding it, and that's always for me worth having a chunk of it in my portfolio. So if you follow my dividends portfolio, you'll know I always have a good chunk of energy in there, even if it is underperforming relative, because I think you'll get eventual rotations and you'll always be getting paid to hold those stocks. But this is what we're looking at now. If we zoom in just a little bit more over the last 5 days, we see some utilities and some basic materials and good old financials taking the lead here. And at the very, very bottom is healthcare, which, as you guys know, was one I warned about. I think it got a little depleted. I actually put a long trade on LLY last week, which is not doing great. Even though I think that LLY got over depleted and has a chance for 3, 4, 5% correction, but last 5 days, XLV continues to be the most underperforming. We also have consumer discretionary or excuse me, consumer staples here, and then tech here near the bottom as well. So just a very interesting flip on its head of a lot of the sector strength that we've seen. Now, why do I do this? Well, I like to see which sectors have the most momentum and if there are major flips and divergences. Because if you're in a market where all the sectors are trending with the broad market, then two things. Number one, you're probably in a relatively healthy market. We haven't seen that super consistently in the last year, but you're probably in a pretty healthy market if most or all of the sectors are trending up consistently with the broad market. And number two, if that's the case, then you're probably best off just trading the top stocks. So if you're in an overall bullish market where everything's kind of trending up, you're not finding kind of protection opportunities. You're not finding, interesting pair plays. You're really just everything's kind of correlated to a optimistic bullish market. Then, in my opinion, just go ahead and trade the best stocks because you're not winning anything. You're not getting anything by just trading underperforming stocks that are in, a similar correlation. So in that case, you might as well trade Nvidia. You might as well trade Meta, and continue to do that because you're trading everything in a correlated fashion anyway. But if you look over the last 5 days and then just even compare that to the last 3 months, you can see a massive disproportionate connection between the sectors that were leading and the ones that were kind of coming in behind. And like I said, the most obvious thing here is to see that energy continually being on the bottom, now having a break from the pack over the last 3 to 4 weeks. Again, certainly I think based on Trump optimism as a key part of that, but also just overdue for liquidity rotation as well. Another thing to keep in mind about energy, never forget this about energy, is that if the opportunity to get income from your cash starts going down, so they're cutting interest rates and your cash is not able to sit there and get 4, 5, 6%, then dividends become more attractive. If you have to settle for 1% or 2% on your cash, when you can get 4 and 5% from a dividend stock, now dividends become more interesting. If energy is not doing a whole lot and it's trending down, and you can get the same premium return from your cash as you can from your dividends, then dividends are a lot less interesting. So if we continue to cut rates, which I think we're going to slow down, but if we continue to do that, those dividend stocks will get more and more appealing to the defensive crowd who want to make premium on their cash because they won't be able to just keep it in those bonds and other things that are paying a high enough premium to hold their cash. And so as we get deeper into that process, those dividend stocks will become more and more interesting. All of that to say, I think there's lots of interesting sectors now, and I think the most important thing is not any one individual sector, but the fact that we need to widen our horizon and look at a lot of other interesting stocks because we're going to start seeing, in my opinion, we're going to start seeing some good old, outperformers like the CCJs and other ones of the world. I mean, GEV already there, compared to just, having the top stocks lead and every bullish day, those stocks lead and every bearish day, those stocks lead on the downside. I think we're breaking away from that, at least in the short to medium term. So that's the big thing that I guess I'd like you guys to take away from this very interesting sector change that, is at least starting. And I think given, that we started it a couple weeks ago and so far have clear momentum and most of those trades or most of those individual sectors, I should say, have solid technical, solid macro, solid bias, like all of the things are stacking up. I think we should give them the benefit of the doubt for now. It doesn't mean I'm going all in on utilities. Doesn't mean I'm going in all in on financials, but I think that we should give those sectors the benefit of the doubt and look for good plays within them. Okay, now one thing I want to mention is the QQQ. You guys know that I had this big range around the QQQ. I really am not planning on trading it super actively outside of my main strategy. So, automated options, overnight options within my investing 2.0, kind of rolling those trades over. I'm not really planning on trading it outside of those main mechanical strategies. However, I do now think that it's set up very well to get to all-time highs. I mean, the momentum that we had started here on January 13th, so we're nearing now 10 days since our bottom with a really good, consistent move. So I think for me, I'm now, very optimistic that the QQQ will hit all-time highs, which is something I wasn't very optimistic about just a week ago, as I thought we were kind of going to, stay in the bottom half of this range and then potentially break the lows and get a deeper correction. Now it looks like, again, at least the short term, that we look like we want to move to all-time high. So that is an interesting, kind of directional bias that I didn't expect to have just a week ago, but now gives me a little more confidence on some of the other plays in there. And again, I'm not going to necessarily trade the QQQ as a directional play because there's lots of other stocks I think are interesting. But I think it is a nice confirmation of what seems like very optimistic bias across a lot of different sectors. And I think if we ultimately break those highs, especially if we do it sooner than later, then you have to give Q1 a pretty optimistic outlook. And seasonally, after a new election, especially, January, February, March are pretty optimistic. They're pretty positive. You typically see a regression in the middle of the year. So April, May, June, July, August, after a new party, especially comes into office, you normally will see a couple months of optimism, which makes sense, especially if it's a significant win. It's a relatively mandated win, we'll say, where much of the business community, much of the population is aligned, which in America today is hard to get, but within reason, you get a decent majority. Then it makes sense that the first couple months, that majority, that mandate is followed through with optimism because the policies theoretically would reflect, that mandate and what people were excited about and the reason they voted. And so again, that makes sense. Then you get a January, February, March of optimism, and then of course, like all things, what have you done for me lately? People kind of fall out of love with the big exciting political win, and now they're just worried about everyday life again. And you typically see a regression. So from a seasonal perspective, that's probably something what we would expect. And I think if the QQQ and the SPY do break all-time highs, let's say by the first week of February, then it looks very promising through the end of March. So that would probably be my highest bullish commitment would be, the whenever we break all-time highs, kind of through the end of the first quarter, looking almost exclusively for bullish opportunities. Now, the SPY is in a similar position as we talked about, a little bit wider range here, but in a similar position. Of course, interestingly, the SPY has now been healthier than the Qs, which is again very different. That's something that is not, not the same for last several years, and particularly in 2023 in the first half of 2024. But then we got to move deeper correction on the QQQ where it corrected almost 18%. SPY didn't correct as deep and has been healthier since that point. So obviously closer to breaking out all-time highs. And I would say same thing. Looks pretty positive. Looks pretty optimistic right now that the SPY wants to get us there. And if it does, and if there is a nice clean break to all-time highs, then you guys know the drill. Whenever we break all-time highs, there's a pretty good chance that we're going to beat all-time highs by several percent. So the reason for optimism is validated. I think the seasonal side, the sector rotation, all of those things point to if we can maintain this momentum for another week or two, it looks real. It doesn't. It switches from looking like just a wave, just kind of another optimistic wave that got corrected, to a legitimate foundation of a new healthy version of a bullish stock market for Q1. And I wouldn't go all in on any individual sector. I think the ranges are there for a reason. I would be careful until we have cemented those all-time highs. But I think most people have pretty good reason to be bullish and optimistic given all of those layers. All right. I know there's a couple of questions in the chat. The other thing I want to cover, because we are already running out of time, these sessions are going to go quick. I'm going to try to get through all my notes when I can, and then I'll stash away some notes when we don't get to stuff for our follow-up sessions. By the way, for all those of you who are members, we're going to have that open house at 3 p.m. today as well. So this isn't the last of me. We're also going to be live at 3 p.m. For those of you who are members as well. So I'll try to cover as much as I can here, but then we could also do a little bit of follow up in there as well. So one of the other things that I want to talk about, let me just scroll through and make sure yeah, Jeffrey, I think that the energy thing is certainly Trump effect. There are other reasons, there are other legitimate reasons in terms of rotation and some of these macro elements, but I think it would be disingenuous to say that the Trump election and the inauguration are not the highest impact, the highest energy, the highest attention focused things. And the optimism around drill baby drill is real. The optimism around deregulation is real. Whether or not it fully comes into fruition, I don't know, but it's certainly starting to be priced in real time here. Yes, I am recording it. It was meant to be streamed to YouTube as well, so that you would have the immediate recording directly with the YouTube link. I was not sophisticated enough to do it today, so I need to go back to the drawing board and make sure I can do that. But for now, we'll just upload the recording and I'll send it out directly to you as a YouTube link instead of it automatically being updated in the YouTube like I planned. But I'll figure that part out. For now, we're definitely still recording. Yep, I will get that out. Okay, so one of the things I want to talk about is buying time. Okay, so this is something that I think is really overlooked. Now, I'm not. It's already 2 o'clock, so we are already past our time. But I just want to spend a couple minutes and talk about this, and then we can go deeper later, just to kind of whet your appetite for what I'm thinking about and what I'm focused on right now. And the thing that I've noticed is that when I talk about spreads a lot, I mean, I'm sure you guys have heard me talk about spreads. By the way, Bitcoin catching a nice bid right now, probably going to hit all-time highs today or tomorrow. Um, if you guys hear me talk about spreads, you'll often hear me talk about risk management. You'll hear me talk about risk to reward. You'll hear me talk about win rate. You'll hear me talk about a lot of elements of why I think there's an advantage. Not least of which is the ability to take advantage of volatility and get outstanding ROI early into trades based on what the market factors in. But one of the things that I think is really important to understand is buying time. And I don't think we spend enough time, no pun intended, talking about time. So what I want to do today, just real quick here, because I got 1 minute, real quick today, is just kind of whet your appetite for why I think this is so important. And then we can get deeper into it the rest of this week. As a matter of fact, I'm working on a new strategy that I talked to a couple of our members about that I've been trading live now. For those of you in the HQ, you know what I'm talking about. Trading live now for several months. And it's been blowing my mind with how productive it is. But the key reason is not just the trade structure, it's the ability to give the market more time to move at a much lower cost. So let's talk about this practically for just 1 minute. I'll leave you with an open loop on this, and then I'll tell you in more detail in one of our next sessions. So here's Apple. Okay, so Apple stock is a stock that I love. It's one that I'm going to continue to buy, even as it goes lower, even if it corrects to 190, 150. Apple stock is a stock that I will continue to buy. As a matter of fact, you can see I already have trades on here for my investing 2.0, where I'm just rolling the positions, just taking new opportunities every time it gets to a lower price. I'm buying more, something I don't mind doing on a select few stocks. Apple is one of them. Now, one of the things that I think is important with Apple is to give it time. So if you're like me, you believe that Apple will hit all-time highs eventually, right? You can give me a yes in the chat if you are in this camp with me, that whether it's next month, very unlikely, 6 months from now, or next year, that Apple will once again make new all-time highs, right? That's the camp that I'm in, and it's a camp that I feel pretty confident in. Okay, yes. Okay, so most of you agree. Now, the challenge with that is that if you want to buy enough time for Apple to do that, it gets remarkably expensive. So if we go to trade, because I'm trading options, of course, and we go to Apple here, and we say, I mean, just look here, for example. So we say, okay, the last time Apple even got in a sideways market, it lasted from August to November. Then we had a nice run. So it was about 4 to 5 months before Apple broke out. If you look even a little bit further back, the last time we had a deep correction started in July, finished up in August. By the time it made new highs from this July, all the way in December. So that's like, 5.5 months for Apple to get going after a deeper correction. So if we were to say, okay, let's give Apple until October, right? Because you don't want to buy a 6 month option. It would have to perform exactly the same. And then you want some time value left. And so for you to give it enough time, you'd probably have to buy October or December options. Now, if you go to October and you want to say, okay, Apple's at 220 right now, so I'm gonna buy it for something like the mid level here. I'm gonna buy the 240. That's way out of the money. Those options should be pretty cheap. As a matter of fact, if you were to go to the 240 options right now, you could buy them for 83 cents. Pretty darn cheap, right? So you could buy January 31 240 for 80 cents, which is a pretty darn cheap option. But as soon as you want to give it realistic amounts of time and you come down here and you buy the same one, you buy that 240 option, now it's 12.75, right? So it is what's that? 16 times the price to go from giving it 2 weeks to 8 months. Well, I guess that's 10 months, 9 months. It's 16x the price to give it 9 months. Now, I don't know about you, but I think Apple has a very good chance of getting up back into the 240s by October. But I'm not sure I'm willing to trade, a $1,200, so maybe a $20,000 option if you're getting 15, 18 options. I'm not sure I'm willing to put 20 grand on the line with a pretty decent chance that it's not a net profit, that's actually a zero. Because the other thing to keep in mind is that, let's say Apple keeps correcting and we hit 205, well, now that option is going to immediately be down 80% because you're buying time in so much direction with it. So the point being, to get enough time becomes very, very expensive, and it doesn't actually increase your risk reward until you're actually back in the money. Now, literally, by just switching to a vertical, which is a debit spread, we can basically make the same bet about it getting back to 240 for $2. And in this case, we're basically making a binary trade where if it gets over 240, we'll make about 150% return, and it has the entire 9 months to get there. So we're buying that time for pennies on the dollar, and we're not paying a big ROI price for that time. In other words, our risk reward isn't now like, well, yeah, you gave it lots of time, so now you're only going to make 10% on the trade. No, we're going to make 150% ROI, even though we're giving it the entire 9 months. And I think this is the most underrated aspect of trading the spread, is that you can buy time for so much cheaper than you can with a regular directional play, even though this is a directional play, because again, you're buying out of the money, you're targeting around 150% return, but you're giving it so much time. As a matter of fact, just to do a little test, if you went and did it in June, so you gave it half as much time, and then you went here to the same, so you went to 240, it goes from $1.83 to about $2. So, you're paying 10% more instead of 5 times more to literally go from 5 months to 9 months. So again, the value of time in the spread is really one of the big advantages that I think goes undersung here as far as trading this structure. And it's one of the things I'm going to talk about a lot over the next couple of days. Excuse me. Over the next couple of days and weeks, because I've been trading a lot of volatility. And the problem with most people who trade volatility is that they can't give it enough time. If you trade regular volatility strategies and you give it a week or 3 days, well, like a lot of people do, then the market typically underperforms volatility. But if you want to give it more time, it gets really expensive. And for me, this is kind of the ultimate hack, to give it as much time as you need. I mean, you could go out and you could give it an entire year. You could give it till, January 27 and still buy it at a pretty reasonable price. I don't know what the actual bid here is. So, um, yeah, maybe a little too high with that spread, but you could probably go 10 months and get a pretty decent price. And with a regular call option, you're looking at $30. So again, time to value ratio. And so for me, when I am waiting for the market to move, what I see most people do is, oh, just go out 6 weeks, go out 8 weeks, go out 12 weeks, move that needle further out. But with regular call options, the risk to reward doesn't merit the extra time. Oh yeah, that's 2 years. Okay, I was gonna say that did seem kind of crazy. So that's 2 years, January 27. I've already moved into 26 in my mind. So literally 2 years later, you can still make that play. So again, I think that this is where understanding how to position yourself correctly within the market, line up opportunities within your overall view, and not get your risk to reward totally out of whack doing so. You have to understand these kind of spreads. You have to understand how to piece them together. And for me, that's a big focus. So again, I'll talk about more of this a lot this week. I just wanted to kind of give you a sneak peek of the general idea and kind of the practical idea of what I'm focused on right now, which is when we're in this kind of market, because you guys obviously know Apple's a great example, but so is Spy, right? If you look at Spy, we're ripping now. I mean, we're back to full momentum, right? Here it is. But in reality, here we go. Since November, we've picked up about 1% in the SPY, right? Less than 1%. So it looks like, hey, we're rolling again. But in terms of net movement, we've moved 1% in over 2 months. And I think it's important to understand that, because as you're trading these volatility strategies, you're going to understand both how to give it enough time and then how to price that time in a way that gives you a good risk to reward and doesn't have you paying out the wazoo with still limited upside. So hopefully that makes sense. Again, I know that was kind of a quick, just a little piece of the puzzle of what I'm working on. I knew I'd run out of time quickly, but it's something I want to get into more in our next couple of sessions. We'll actually talk about it a little bit at 3 p.m. today too for all of our members. But you'll hear about it, in Telegram next week. Got a lot of good stuff cooking, and a lot of it centers around a new strategy that I've been working on and trading live for the last couple of months that I think will blow you away in this kind of sense, that you can give the market time, that you can trade any direction where all you need is a move, and you don't have to force it as a day trade or as a tomorrow trade, but literally give the market weeks to make any kind of move and still come out on top. And I think that's what most people really have a hard time doing. But once you understand how to buy time at a discount, it really makes a lot of sense. Brian, I don't do credit spreads very often when I give it lots of time because I don't really want to have the risk of assignment hanging out there for 4 or 5, 6 months, or even 2 weeks. Really, I prefer not to have the risk of assignment sitting out there when I can do it as a call spread and really remove that risk of assignment totally, but still have the same upside. Okay, I know I didn't get to every single question, guys, but I will. I'll try to get to more of those in the follow-up sessions. I'll get this recording put together and sent out. I'll work on getting it so we can stream. Yes, Stacy, a call vertical. Yep, and I will. I'll also try to get that stream cooking more organically moving forward. Um, as far as when I actually release the strategy, Nathan, I think I'm going to try to push the pedal to the metal here and do it next week. I'm going to be talking about it a little bit this week, but I'm going to try to get it rolling. We have enough live trade data that I think it's pretty rock solid. And I'm, for me, to be perfectly honest, which maybe this is not a good thing, I don't know, but for me, what typically happens is I base it on how excited I am. That's how fast I move on trying to get this stuff, put together in a way that people can, join and take advantage of it. And this is, kind of peak excitement for me because it just ties in so many of the different things I've been working on, buying the time, the volatility strategies, trading in both directions, all of that kind of stuff. So when I get pretty amped up, I basically, force the agenda. I don't think the team is always appreciative of how quickly I force the agenda. But in this case, we have enough live trade data. I definitely have more than enough testing. and stuff to feel very confident about it. So I'm pretty excited about, pushing it out as quickly as I can. I'm going to try to put all the pieces together this week so that it's ready to go. And hopefully you'll be, hearing something official by Friday or Saturday, if I can get all of the rest of my pieces put together. So that's the update, but I'll keep you in the loop fully as we go along here. All right, thank you, everyone. I will see all the members here at 3 o'clock. Thanks for being here. I know I didn't get to every single question. I'll try to make up ground for that as we continue to do these sessions. I'll look forward to kind of giving you some updates along the way as well, whether it's just a couple videos that I post in the Telegram, or some more of these bonus sessions and things like that. Thanks, everyone.